Life and Annuities. Wanted to welcome you again to another Life Weekly program. Today I have Michael Brandenburg with us. He's a Regional Vice President of American General, AIG, and he's got some great information he's going to be discussing with you guys today. Be your own beneficiary of your life insurance benefit. Michael, are you there?
I am. Good morning.
Good morning. How are you doing?
I'm doing excellent. Hope you had a great Easter.
I did. You too. Hey, it kind of give us some information on be your own beneficiary of your life insurance benefit. What is that about? Can you explain that to us?
Absolutely. You know, we have a contract which really has a completely different approach now, and it allows an agent to propose something to their clients from a completely different point of view. And one of the things we like to call it is protection your clients never knew they always wanted. It's so different. Imagine your cell phone, the cell phone that you did have, like, say, 10, 15 years ago, right? It made phone calls, not much more than that. But everyone thought it was pretty cool because you could actually walk around and make a phone call, which was pretty different than the old-fashioned landline tied to a wall. Well, compare that to your current cell phone, or smartphone rather, and all the amazing things it can do. You don't just make phone calls. You can transfer money on your bank account. You can get directions. You can FaceTime people. You can, play games. It's amazing, right? It does all these things.
Right.
But imagine what that. You couldn't imagine doing that 10, 15 years ago on your cell phone because you didn't know such a thing was even possible. And that's kind of how we look at our new Asset Protector product, which allows a client to be the beneficiary of their own life insurance policy. It's so different, people wouldn't have imagined it because there was nothing like that previously. And that's kind of what I compare this product to. Most people, of course, don't know about it. So if you don't know about it, you can't, know that you want it, right? That's why we kind of have the protection your clients never knew they always wanted. So let me just kind of walk you through it. From the very beginning, you can start off with saying something to the effect of, hi, Mr. Client, how would you like to, or have you ever thought of being the beneficiary of your own life insurance policy? Completely different proposition. It really, by the way, as a side note, really kind of plays into the what's in it for me sort of mentality in America these days. A lot of people like life insurance. It goes to the next generation. It's the ultimate gift of love. You think back to when you first learned how life insurance works. But now there's the opportunity for some of those benefits to actually be taken advantage of by yourself, the actual insured. So, just thinking about this, and gee, I wish this was the case, but clients just don't stay awake at night worried about their own life insurance, do they? I wish they did. All of us would be in better shape, the carriers, the agencies, and agents selling a lot more insurance, but they don't. They sit around and worry about retirement typically. At least that's what a lot of our statistics say. In fact, like 2/3 of Americans surveyed say they're more afraid of outliving their retirement assets than they are of death. So they sit around and worry about that sort of thing. So our thoughts are, why not focus your efforts on solutions that fit the client's pain point, which is this idea of what could happen during retirement if I haven't saved properly, or if I have some health issues, or go through more money than what I had originally planned. So refocus your efforts on retirement insurance instead, because that's what people are worried about. We know that if you saved for 20 years of retirement, there's a good chance that wouldn't be enough for your own retirement. People are living longer, and that's really what's going on there. 1 out of every 4 65-year-olds will live past the age of 90. So if you saved for 20 years of retirement and you retired between 60 and 65, you're going to run out of money. We know that some people, and it's amazing that this statistics could be true, but 41% of folks have retired earlier than they planned due to a personal health problem of some sort. And so for those sorts, they didn't even work their full number of working years because of health issues. Very few Americans get to retire on pension plans anymore, so they don't have that to lean on.
A lot of people used to rely on Social Security.
Well, you know, I think everyone is going to, but they had something in addition to that because Social Security was never going to be enough. You know, in fact, when it was designed, it wasn't designed really to be the retirement program. And people's saving rates aren't that great. I'm told that the average 401k balance among the baby boomer generation is less than 127,000. We'll spread that 127,000 over. Well, heck, if you only spread it over 10 years, it's only 12, 13,000 a year, and if you spread it over more than that, then it gets a whole lot smaller. So people haven't saved enough. So we know that a lot of people are going to have their household at risk of a decline in standard of living during their retirement.
It's kind of scary
Another
nowadays.
one of the big. I'm sorry. Go ahead.
So that's kind of scary nowadays.
It is, and I think one of the things that really jumps out at people is that clients can outlive their retirement assets due to the health care expenses, and that's really a really large wild card right now. You know, one of the statistics that we have is that the average couple retiring today at age 65 can expect to pay out of pocket for their medical expenses during the course of both of their retirements before they both pass away, on average $220,000. A lot of people don't even have that kind of money saved.
No.
So that scares a lot of people because specifically, no matter whether there's Obamacare, whether there's not, whether whether they have good health care or not, the fact is a lot of things end up being paid out of pocket. And people don't really know necessarily where that money's going to come from. 73% of respondents in one of our surveys say that major health care problems are the primary concern about if they live to age 100. So there's so many different things. I mean, like the average cost of cancer care per month for a cancer patient is supposed to be about $1,266, and that's the out-of-pocket number.
Wow.
These things are very expensive, and they can make someone's savings or a family's savings destitute, especially when there's one person that is having the health issue, but the rest of the family is going to be around afterwards, right?
Right.
So with this idea of retirement insurance or this new generation of life insurance, which can be proposed, we think for most one of three things is going to happen. The client could die too soon, they could get sick along the way, or they could live a long life. And life insurance, of course, traditional life insurance with a death benefit takes care of dying too soon, right? But how do you take care of getting sick along the way or actually living a lot longer than you ever planned?
You guys got a perfect plan for that, don't you?
And we do. That's this idea of the asset protector, which is a package of living benefit riders. It's a chronic illness rider, and it is what we call a longevity rider. The marketing name is the Lifestyle Income Solution. The chronic illness, most people are familiar with, but there's still a lot of agents still learning to sell the chronic illness, and I think it makes a lot of sense. It allows a client when they no longer can perform 2 of the 6 activities of daily living or severe cognitive impairment to be able to turn on an income stream from their life insurance policy. And of course, that it greatly helps in times of need when the client is going through some pretty severe health scenarios. So we have a rider, of course, that attaches to that, but we also have the unique one, which is really revolutionary in the business, and that's the longevity rider. What if the opposite thing happens? What if the client is going to live longer than they expected, and now they've kind of like in the football analogy, outrunning their coverage, so to speak. They're outliving their retirement assets. Well, now you got a whole other kind of problem. And I think that scares a lot of people, too, if they sit down and think about it long enough. And
can you explain a little bit about the longevity rider, like how that really affects people with the policies that you have?
Sure. So if you have this rider on the contract, it is an age-based trigger. There's no health involved, so to speak. The health is that you've got good health and you live a long time. So there's basically one requirement. It's really pretty simple. At age 85, the client has this rider on their contract. They can turn on an income once the client hits 85. What I like to say is once the client can blow out 85 candles. At that point in time, they can turn on the income rider and, in effect, spend down up to 10% of their death benefit per year. And they can take less than that. They can start and stop it. They can not use it, and it's just regular death benefit that passes on to the next generation. But what it puts a client in the position of is if they are living longer, now they have the opportunity, if they should need an additional income, to turn on 10% of their death benefit. And you're actually not spending down the cash values. You're actually spending down your death benefit, your own death benefit. And so it becomes a great backstop or a great plan B to implement should a client's financial situation require it. And that's
so if they apply for $1 million worth of death benefit in their 50s, and by the time they reach 85, they have no health issues at all, which does happen, no health issues at all at age 85, and they decide, like, I need 10% of my death benefit, so $100,000. That's what they'll get at age 85. They can accelerate the $100,000 or part of that $100,000. Is that correct?
That's correct. That's exactly the idea. And it's not necessarily that they're in perfect health. It's just that they reach the age of 85, right?
Okay.
I mean, for some people, I could imagine that if they live that long, that'd be great, and they decide, well, maybe I want to turn it on, maybe I don't, depending upon how their finances look at that point in time. But even if they did turn that on at some point in time, let's say they're 85, and they decided to take a portion of it, should they have a chronic illness happen, because statistics are very strong on that point that most people, most senior adults have at least one chronic illness. Something like 3/4 of them have two. So in effect, it's almost not if, but when someone eventually has a chronic illness in their lifetime. So if they had started the income benefit just because they lived that long and decided to and said, well, let's have some extra money in the budget, we can spend some time with the grandkids or take some more vacations with the family, whatever it happens to be, and then they actually have the chronic illness later, they can flip over to that rider, and that rider actually pays money out more quickly to help with chronic illness type expenses then.
So your chronic illness rider, you just mentioned too, that's a dollar per dollar benefit, correct?
Yeah, absolutely. That's every carrier right now is doing that differently, and it must be very confusing from an agent's perspective because every carrier is doing their unique little wrinkle on it. The way ours works, we do have a charge for it. There is underwriting that goes on as part of the underwriting of the life policy. But when you put the chronic illness rider on, then when it's time to flip on the chronic illness benefit, you actually spend down your benefit dollar for dollar, and you know exactly what you can get out of your contract. I contrast that with a lot of other carriers where they may position it as a free rider or something to that effect. But the reality is you don't know what kind of income stream it's going to produce on the back end until that event happens, and you know what year it's going to happen. So in a perfect world, if you knew exactly when you're going to need it, well then the other type of rider is probably the good idea, the best idea. But who knows when they're going to need the rider. So our approach is to have a fully guaranteed one. And then when it happens, you know exactly that you could literally spend down your entire death benefit with the chronic illness rider should you need it.
I have an agent asking a question here for how many years, and the nice thing I like about your software, when we run it here, it actually illustrates how many years they can use the accelerated rider, the chronic rider for, but you've got a couple different options for them to choose. Can you explain those options?
Sure. Right. So when the client is purchasing the rider, you can purchase the benefit in one of three options. You can purchase a 2% benefit, which means it's 2% of the death benefit paid out per month. You can purchase a 4% option. Again, 4% of the total death benefit paid out per month. And then there is a really unique one, the third option, which we call the IRS per diem option. And what that means is in the year that the insured would put a claim in, whatever the per diem is for that year is the maximum amount that the client could take out. And that, in effect, is kind of like buying a cost of living increase rider, because almost every year the IRS per diem, or the maximum amount that the IRS lets you take out tax-free, continues to go up. For the current year, it's $330 per day, or $9,900 per month. And so that option would mean that by the time, let's say, it's particularly good for younger folks, because if you're going to be around a while and you may not need this rider for 30, 40, 50 years, definitely the cost of living is going to be different. What's it going to be? Who knows? Well, this would enable the payout option to be whatever the IRS per diem happens to be for that year. So by then, if that number's gone up to $15,000 or $20,000, you could take out that amount per month, because who knows what the healthcare costs will be at that point in time, right, Kathy?
Correct. It always changes.
Yeah. The other neat little wrinkle that we have on ours, let me just throw this in real quickly, is that if a client goes on chronic illness rider claim, there is a waiver of monthly deduction that kicks in that allows the client to be able to receive their benefits without worrying about any more payments for the policy. So the life policy, in effect, is taken care of internally. And that's something that's
nice.
Included with each contract. There is a distinct and separate waiver of premium, more traditional variety, but this waiver is specific to the chronic illness rider.
That's very nice.
Can come in very, very handy.
Another question here on your illustrations. When you're showing a 2 or 4%, and let's just exaggerate here and use $1 million life insurance plan because that's easier, they can actually show I want $500,000, so 50% of my death benefit to be on the 2%. Is that correct?
Oh yes, yeah, absolutely. Good point too. You don't have to purchase the chronic illness rider benefit to use the entire death benefit. You can dial that rider back to 50%, anywhere from 50 to 100%, such that when the client would pass away, on average, clients with a chronic illness last somewhere between 3 and 4 years, they say typically. So that in effect you wouldn't consume the entire policy, and then, there's residual death benefits still passing on to the beneficiaries. And by the way, that makes the rider cheaper, number one. And secondly, especially if it's a larger policy that they wouldn't necessarily need that much funds, it also makes the policy cost of the rider a little less if you dial it back. So yeah, absolutely, you can basically thin down the chronic illness rider.
That's a really nice plan too.
So,
I think we do a lot of illustrations showing the 2%, and sometimes we've done 90%, sometimes we do 100%, or we've run it at 50% here in our office.
mm-hmm.
But it's something really nice to talk about to your clients and give them that option, especially if they should be applying for a larger death benefit when they're younger.
Absolutely. And Kathy, we have some really great materials on our retirestronger.com website that have like the Steve Scumaci video, which is a producer of ours that's basically sold more of these asset protector contracts than anyone else in the company. We were so interested with how he was presenting the story, and I used some of the words that he uses, like, have you ever thought of being the beneficiary of your own life insurance policy? He uses that all the time, or the new generation of life insurance to get people to look at the insurance a little differently. But we filmed him, and his video's out on this retirestronger.com website, as well as a bunch of support materials, like with statistics and so forth, to help agents as well as clients kind of think it through and say, wow, there's some definite risk out here. How are we planning for that long term? I mean, you can bury your head in the sand and just hope it doesn't happen to you. But if you really want your family to be successful and move on and leave a legacy, then planning for it obviously is the best thing that a client can do. So these pieces really help just kind of lay it out. I like the factoid pieces, kind of like the little factoids that are on the USA Today on the left corner always. They have little factoid pieces there, and that's what these pieces are like. So it doesn't really sell anything. It just helps set the table for an agent to be able to show a client, this is kind of where we are now. This is how much it typically costs. This is how high the risk is. Why don't we think about addressing that in your planning? We find those very, very helpful.
Oh, yes. Another question here. Someone's asking receipts required on your accelerated asset solution.
Great question. Yep, great point. The nice thing about the 101G, that's the IRS regulation on chronic illness rider versus a long-term care rider. On chronic, there's no required receipts. So when a client cannot perform 2 of the 6 ADLs, activities of daily living, or has severe cognitive impairment, when their health professional signs off that that client is in that scenario, they would send in the paperwork to Policy Owner Service, and at that point in time, they could turn on their income stream, subject to that maximum that they purchased, or take a smaller amount. But the bottom line is there's no receipts. So they can spend the money on anything that the family thinks they'd like to spend it on. So it's very freeing and very flexible. The client's family then is able to address whatever they want to, as opposed to a reimbursement variety, which means that you have to have a receipt to get any money out of the company. So we kind of took the more flexible route on that, on the chronic rider there. And like I say, there's no receipts involved then.
Another question here from Bob. Issue ages on these, and how tough is the underwriting?
Great question there. The asset protector, if you want the package, is issued up to a maximum age of 70. But if you only did the chronic illness, you can actually push it up to age 80 if you were leaving out the longevity portion of the rider. As far as underwriting is concerned, the longevity portion really doesn't have any other underwriting to it. It's whatever the life policy has. The chronic illness portion is really long-term care type underwriting. Really underwriting for the morbidity. What are the odds, that someone is going to need a rider? Because the company, in effect, is not going to want to hand out the policy to someone who's going to have a claim real soon. We call that kind of buying a claim. They're obviously not going to want to do that. So the long-term care type of underwriting, as you've seen with those applications, will ask questions like, does the person use a 3 or 4 prong cane? Are they on dialysis? Do they have MS? Do they have Lou Gehrig's disease? And all of those type of questions, we call those knockout questions, because generally if someone's already in that scenario, then they're not going to get to have the chronic illness rider. So it actually is distinct from traditional life insurance type underwriting on that portion of the rider. Did I kind of answer that, Kathy?
I think you did. Yep.
Okay.
Okay, here's another question here. What additional licensing for the agent do they have to do, or extra classes or anything that they have to have before they could sell?
Oh, sure. Yeah, that was that's the part that we also really like about the chronic illness rider, because because it's 101G, it doesn't require the long-term care licensing. So in most every state, then that's just going to mean that your regular life license is all you need. Now, every state does it a little bit differently. Some join the life and health, some don't, as you know. So in our case with this, there's no additional licensing or annual CE that's required specific for that rider. The longevity rider doesn't require anything different because it's just a rider on the life policy.
Nice. And if you were going to go out and sell this today to, let's say you've got a meeting with the clients, what's one of your first questions that you would ask them to get them interested in this product?
Well, I like to start with what our friend Steve Scumaci often says, is that, have you ever thought of being the beneficiary of your own life insurance policy? We know that there are some people that have purchased this, haven't just done it for the traditional, things. I have a mortgage. I have a large business debt. I have something else that I want to make sure is covered so that when I pass away, the family gets this thing free and clear. We know that some people are looking at this as, wow, here is another interesting angle that I could help take care of my family, either as I'm having chronic illness riders later in life, and or if I live a long time, I have another pool of funds that I can tap into. Because most insurance policies really are an illiquid asset, and this allows you to turn an illiquid asset into a liquid pool of money. And I think that a lot of folks, once they're presented with this, really start to think, boy, if I have some longevity, I have another pool of funds I can tap into. And I think the so what of that really is putting people in a position where during retirement they don't have to be, I live in Wisconsin here, and people here are just notoriously frugal. I mean, just absurdly frugal. It's just a way of life here, I guess. And it allows people can tend to be, during their retirement years, not enjoying their retirement because they're still so frugal with everything. And they, what if big expenses come? What if something happens? What if I live too long? I'm going to need all these funds. And so this is kind of like a outlet valve, for your savings plan or whatever, that in case you need some more, there's a backstop. There's a plan B pool of funds that you can tap into later. And I think that's part of the story. Hey, enjoy your retirement. Should you live a long time or should you need more funds later, there's ways we can access this other pool of funds. And quite honestly, I think a lot of agents could very well go back and visit most any of the clients, as long as they're healthy enough, of course. Go back and visit those clients again to say, hey, we've got something new and different. Have we thought of positioning your assets such that one of your assets, a life insurance policy, is actually going to turn into cash later for you? And I think that's the new wrinkle. That's something else. That's the new generation of life insurance that Steve Scumaci likes to call it.
So for anyone, kind of just what you just said there for a second, jumping back, when you go back to visit clients that had term plans in the past, can they now get the plan, the GUL plan with the riders, or how do they go back and do that?
Well, if they had purchased our term plan, technically speaking, because you're not converting something that includes the rider, you can't really get the riders without going through underwriting again.
Okay.
My recommendation is to go ahead and purchase some of the permanent coverage, because it is a permanent GUL contract. And the sooner the better, because the longer you wait, of course, the more odds that there's going to be some health issues down the road, and or someone's attained age keeps getting higher and it gets more expensive to purchase later. So we don't have a way to really do it where go out and sell term and then you can just do this plan later. Certainly you can sell term and revisit the idea later, but that in that case it would require new underwriting then.
Okay.
Whereas if you just wanted to do a straight conversion, Of course, you could always just convert to our GUL within 5 years, and that would require no more insurability, but that would not include the riders then.
Okay. Got another question here. Does this type of plan have a paid-up option, such as a 10 or 20 pay?
Excellent. Yes, thank you. It's UL is what I'm trying to say. In a GUL contract, you can long pay it or short pay it, and that's actually part of when you ask for an illustration, and Kathy's team runs one for you, or whoever, if we run one for you, you'll see that if the longevity rider is going to be on the contract, it does require the contract to be paid up by age 85. So at the point in time when you're going to flip the income on, the contract does need to be fully paid up. So although I think that does make a lot of sense, a lot of people, if you think about it, really don't want to be making insurance payments during their retirement years, because the policy's not paid up yet. And so it actually does work rather nicely. A 50-year-old, you can do a 35 pay to 85, and then it's completely paid up. And the software won't let you do it. If you have the longevity rider on, the policy does have to be paid up by the time the income may be flipped on.
Nice.
Does that answer that question?
It did. I had another question pop up. I think you just answered it. This is a UL policy then versus a whole life policy.
That's correct. Exactly. This is actually a guaranteed universal life contract that has the chronic illness rider as well as the longevity rider. And that actually brings me to the point that is never in my slides or never in my presentation, but I think is one of the strongest features of all this, is that everything is fully guaranteed. It is a guaranteed UL contract with a guaranteed rider, the chronic, and a guaranteed longevity rider. So there's no moving parts in this entire system. Some folks like to put their money in vehicles which have a lot more risk and have possibly more reward down the road. But on the other hand, there's risk to it. Our plan, the Asset Protector with the GUL, is completely guaranteed. So you know exactly what it's going to cost you, and you know exactly what you can get back out. And I think that is very, very satisfying and reassuring to most clients to know that they're going to have this thing in place, guaranteed. No moving parts.
I thought this was ironic that I got an email sent to me today that talked about myths of life insurance plan. And one of the myths was, and this fits perfectly, what if I'm a single person? Why would I want to buy life insurance? Because you are single, this is a perfect opportunity so you can actually have some additional benefits here.
That's exactly right, Kathy. I didn't mention that. I mentioned the what's in it for me generation, but I didn't mention the fact that single folks, when I first started in the business and most of my friends were single, a life insurance sale was tough because it's like, what do they need it for? They're not taking care of their family. Most of my friends, of course, are married now and have children and so forth. But a sale like this certainly can go to someone who's single, whether young or older, right? It works the same way. This can be part of actually your retirement plan as opposed to taking care of the next generation, right?
Correct. Yeah, I think that fits perfect. First thing I thought about when I read that myth was your plan right away. It's like, well, this works perfect. We can talk about it today.
Single, that's exactly right. If you're young in the business and most of your friends are single, life insurance can be a long shot for a lot of folks, and we just don't see the need for it. But hey, this could end up benefiting yourself. So it can make a lot of sense for a single person.
Okay. I had one agent got on late. Can you explain the longevity rider, exactly what it is again, just real quick?
Sure. The longevity rider works like this. You put it on an issue, and the longevity rider is basically insuring you against living too long. So should you live to age 85, there's but one requirement to turn on the rider, and that's that someone live to age 85. As I like to say, blow out 85 candles. At that point in time, the client can turn on their income. They can spend down their own death benefit up to 10% per year. So at that point in time, if they had $1 million contract, for instance, they could take from the contract $100,000 annually until they consume the entire policy, Should they not live that long, of course, the residual is death benefit, and the residual would pass on to the beneficiaries. But the bottom line is there's really no health requirements to it. It's simply a function of living to the point in time where you can turn on the income stream at age 85.
Wonderful. I think you answered his question perfect. So, well, as long as there's no other questions, Michael, I think you did a great job today. Thank you for joining us. I do know last week we talked about doing a webinar. Yeah. Oh, someone did pop up another question. Is there a critical illness rider?
We do not have a critical illness rider on this contract, at least at this time. I know the company's working that direction because there's other corners of the company that have those kind of riders. We actually, on the American General side, actually have a standalone critical illness rider. But currently we don't have the ability to put it on this contract. I know we've been going through a lot of new business changes and platform in the background for issuing and policy owner service purposes. And I know part of that plan long-term is the ability to add some of these other riders. So stay tuned. One of these days we hope to be able to fill you in on that as well.
That'd be awesome. That'd be great.
Mm-hmm.
Well, I will be contacting you and talking to you about a webinar coming up, going over this in more depth. That way we can actually see slides and more in-depth information on that. So we'll work on that sometime, hopefully in May, getting that together and working on that. But thanks, everybody, for taking your time. If you have anything else, Michael, you want to share with us before we let everybody go for the day?
No, we talked about here life insurance. You don't have to die to use. But on the one other thought, just if it's a great little idea, and I forget to talk about this so often, is just good old-fashioned term insurance. American General's rates are extremely competitive right now, as you know, Kathy. And we have an idea called term laddering, and that's a great idea. And basically the idea is sell the need to the client. If a client calls you and says, hey, Bob, I need $1 million, a 30-year term, that's great. You can sell them. We'll be happy to sell you $1 million, a 30-year term. But you ask some questions, say, well, tell me kind of what you were thinking there. And it turns out, he's got like a 22-year mortgage that he'd like to cover. He's got some kids that still haven't gone to college. He wants to make sure that they could go to college. But once they're through, he wouldn't want to have that term laying around again. And then thirdly, of course, is just good old-fashioned income replacement. Well, you could ladder those durations so that maybe, $250,000 is 22-year, maybe another $250,000 is, let's say, 26-year, and then maybe the income replacement portion is 28-year. And the reason, if they're all different like that, with our term, we actually have terms to match the duration. That can save the client a bundle of money. You actually sell individual term policies of different durations then, because we don't just have a 10, 15, 20, 30-year term. We have 10, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24. You get the idea, all the way up to 30. And so that's called our term laddering idea. And first of all, no one else is able to do that, so it's kind of a unique little thing we do. Secondly, it's competitively priced anyway, but it saves the client money. And last but not least, certainly, is that we like to say if you save the client money, you may have found some change on the table for maybe one of the other products that you can sell that the client actually really needs also. So it can also be a way to find some more money in the budget, right? So that's that term laddering idea. I'd love to go into detail on that sometime when you all have some time.
That'd be great, too. We do show a lot of agents that, because that is at our website right now, how you can actually quote that it's available to show.
Terrific.
That.
Well, thanks, everyone, for the time today. I hope we haven't gone too long.
Nope, we're doing great. So everybody have a great Monday, and if you have any questions, please feel free to get in touch with us.
Thanks, Kathy.
The number here is, not a problem. The number is 1-800-365-8208. My extension, I guess, just ask for a life marketer, and you'll get one of us. Take care. Have a great day. Thanks, Michael.
Thanks, everyone.
Bye-bye.
Thanks for joining us. Bye-bye.